Hello everyone, welcome back. Here is Ali Talibi and this is our review session for Module 17, Payout Policy. So let's start our session. In this module we'll learn regarding the payout policy. So we talk about the stock repurchase, a stock split, cash dividend, a stock dividend, and we mentioned that a stock repurchase and a stock dividend are actually alternatives to the cash dividend. For the cash dividend and stock repurchase, shareholders will receive the cash. However, there is no cash receipt for the stock dividend. And also, we'll talk about the financial implication of different payout policies. We also mentioned that the cash dividend and the share repurchase, they leave shareholders in the same financial position, so the total market value of their investment won't be affected following the cash dividend and the share repurchase. So there is no difference in terms of the impact on the financial position. And we also mentioned that this stock split has no financial impact. It just increases the number of outstanding shares and it reduces the share price accordingly. However, when we see the market reaction, we notice that most of times it actually changes the financial position of investors. And remember the importance of signaling and the information content of the stock split. Usually when companies they go with the stock split, it means they are preparing the ground to actually increase the share price in the future. So that's the preparation of the future growth. So there might be some increase in the stock price. Although on papers we see there shouldn't be any kind of impact when it comes to stock split. And also another important factor is something which we call clientele effect. What is that? The impact of firms' dividend policy depends on the demands and goals of its investors. Different investors, they have different expectations. Some of them are looking for the high dividend yield. Some of them, they don't care about dividend and they're more concerned about the capital gain. So different clients, different investors, they have different expectations. So firms, they need to consider the goals and actually incentives of their investors when it comes to setting their dividend policies. And always remember that the market imperfections and irrational investors, they play a major role in determining the stock price and the financial implication of the payout policy. And they can change the impact of those policies. Finally, we talk about the tax implication of the investment. And we mentioned when you decide to buy a specific stocks, remember that the taxes on dividends and capital gains are different. For example, in Canada, we mentioned that the dividends are taxed at a higher rate than capital gains. In the US, it's kind of more complicated. Please go back to the second lesson as we talk about the tax implication of capital gains and dividends. Now let's start looking at the questions and answer those. So here's the first question. DR Corporation just paid the dividend of $3 per share. It forecasted a $5 per share in earnings and had a stock price of $60. Determine the stock price if you declare 40% a stock dividend. So we mentioned when we talk about the stock dividend, what's the implication? So when the company is going with the stock dividend, the number of shares will go up. However, the stock price will go down. The total wealth won't be affected by this decision. However, we have to adjust the stock price accordingly. So the number of shares will go up by 40%. The price should be also affected. What's the new price? So it should be $60 divided by 1.4, which is 1 plus 40%. And if you divide it, you will get to $40.85. So that's the implication. The stock price is going down. So since we have 40% more stock, you should go with the price, which if you multiply that by 1.4, you should get $60. I've seen some of my students, they get confused and they actually multiply $60 by 60%, for example, in this case, which is not correct. You will get different number. You got $36. You have to divide it by 1 plus that stock dividend, which is 40%, because you want just to have the price, which after adding that 40%, you get that $60 price. So be careful. You never multiply that by a stock 1 minus a stock dividend. You have to divide that by 1 plus a stock dividend percentage, which in this case is 42.85. So the correct answer should be D. Let's look at the next question. GJ's shares are selling for $42 per share. What is the newest stock price of the company if the company goes with actually 7-for-3 stock split? Here you have to be careful because when it comes to a stock split, the price for sure will go down. Now, how much the price will change? You have to go with the inverse ratio. For example, if the stock split is 2-for-1, you have to actually divide the stock price by 2. Now, if the company goes with 7-for-3, so remember the stock price should go down. So you have to multiply the stock price, the current stock price, which is $42, by 3 divided by 7. So it's 7-for-3, multiply that by 3/7. If it's 2-for-1, multiply that by 1/2. So you should go with the inverse ratio. So be careful with that. So if you do so, you should get $80 for the new stock price. So B should be correct answer. What will happen to the number of shares? The number of shares will go up by 7/3. So the same ratio should be followed for the number of shares. The inverse ratio should be followed when it comes to a stock price. So let's look at the next question. Before the payment of 50% stock dividend, you had 1,000 shares and $2,000. What do you have now after the stock dividend? So we mentioned a stock dividend will increase the number of shares with the same ratio. However, the total impact on your value or the value of investment won't be affected. So you have 1,000 shares. When you go with the stock dividend, you receive additional 50%, which means now you have 1,500 shares. What about your total investment? The value of the investment on paper shouldn't change. So it should be, say, $2,000. So 1,500 shares, $2,000. So the correct answer should be C. As we mentioned earlier, the signaling is kind of important. So the actual impact on the market should be might be different. However, on papers, you shouldn't see any changes on total value of your investment. So C should be correct answer. Let's look at the next question. What is expected to happen to the stock price when the stock goes ex-dividend? So we're ignoring taxes. So we talk about the ex-dividend. We talk about the dividend payment process. And we mentioned that the ex-dividend is that actually the day which the impact of dividend is taken out from the stock price. So we are expecting that on ex-dividend date, the stock price is going down by the same amount of the dividend payment. For example, let's go with a very simple example. Let's assume just before ex-dividend, so we call that the with dividend or comp dividend date, the stock price was $15. The company decides to pay $2. So on the next business day, the stock price should go down to $13. So this is the ex-dividend date price, $13, and $15, that's the with dividend or comp dividend date price. So the answer accordingly should be B. It should decrease by the amount of the dividend. Let's look at the next question. Capital gains may be preferred by investors over dividends, even if their tax rates are equal. So in some cases, investors, they prefer capital gains. What's a capital gain? Again, that's the changes in the stock price. Why is that the case? Remember, when the company decides to pay dividends, so you will receive that dividends if you like it or if you don't like it as an investor, and you have to pay taxes for that. However, you have some sort of control on capital gain. You won't realize any tax payment until you realize the profit. So if you don't sell your stock, even if the price is now, let's say you purchase the stock at $10, now it's $15. So that's $5 capital gains. But as long as you haven't sold your stock, there is no profit realization, so you don't need to pay taxes on that. In other words, we can say you can time your tax payment when it comes to capital gain. So that might be the reason some investors, they prefer to go with the capital gains even if there is no tax saving on that, because they can time the tax payment whenever they want. They can sell their stocks and they can pay taxes accordingly. That's the one major benefit of the capital gains. Now, let's look at the next question. The next question is talk about, actually it's another descriptive question. Is it possible to see lower stock price following an increase in dividends? Now, we mentioned when we talk about the dividend payment policy that companies, they never ever increase their dividends unless they are confident they can keep that at that kind of new level. Investors, they hate to see their dividends is being reduced. So remember, if dividend increase cannot be sustained, there will be some consequences. The stock price will go down. So the case in which the stock price will be lowered following an increase in dividend is the case the company is not able to keep the dividends up. So for example, the company, let's say, paid dividend at $2. Now they're paying, so the $2 is going up to $3, and the next quarter they go back to $2 or $1. So in this case, the stock price will go down because the company was not able to keep the stock price at the dividend payment at the previous level. So let's look at the last question. Question 7. You own 10,000 shares of a company, which is 10% of outstanding shares before a stock repurchase. Let's assume you did not sell any of your stock during the 50,000 share repurchase. So what's happening here? The company has how many shares? You can calculate that. The company has actually 100,000 shares before the stock repurchase. How I got that? It's just 10,000 actually divided by 10%, because you own 10%. The 10% is 10,000, so the total number of shares should be 100,000 shares. Now the company is buying back 50,000 shares of its outstanding shares. So what's happening here? So it should be 100,000 minus 50,000 shares, which is 50,000 shares. So the total number of outstanding shares is going down from 100,000 to 50,000. You used to own 10,000 shares. You still own 10,000 shares because you didn't participate in the stock repurchase program. So you had 10,000 shares. You still have 10,000 shares. So you had 10%. Now you have 20% of shares, outstanding shares of the company. So you own 20% of the shares of outstanding companies. Now let's look at the statement, see which one is correct. The investor still owns 10% of the corporation, which is not correct. Now you own 20% of the company. The stock price is likely to drop by 10%. Now, when the company goes to a stock repurchase, I mentioned the number of shares is going down, and most probably the stock price will go up, and most probably the market value won't be affected by this decision. But for sure, the stock price is not going down, so B shouldn't be the correct answer. The investor owns more than 10% of the corporation, which is correct. Now you own 20% instead of 10%, so C should be the correct answer. The investor now has 15,000 shares, which is not correct. You still have the same 10,000 shares, but the percentage of ownership has been increasing. Now, thank you very much. That's it for today. Have a wonderful day. Talk to you soon. Here is Ali Talabi. Stay safe.